Okay, let's be honest. Are you paying way more in taxes during retirement than you really have to? You probably are, and you might not even realize it. Today, we're going to break down 5 really common and really costly tax mistakes that could be quietly draining your savings. Let's dive right in.
So, what's the price tag on these mistakes? How about $150,000? Yeah, you heard that right. That's what the average retiree could lose over their lifetime. And get this, it's not from some risky investment blowing up. Nope, it's from simple, totally avoidable tax errors. That's a huge piece of your nest egg just gone. And if you're thinking, well, that won't happen to me, think again. This is not some rare fringe problem. A staggering 73% of retirees make at least one of these 5 mistakes. I mean, that's nearly 3 out of every 4 people. So the odds are this is happening to you or someone you love right now.
All right, let's start with the big one. We call this retirement's $150,000 tax trap, the RMD tax bomb. And it's called a bomb for a reason. It's this hidden trap that so many retirees just don't see coming until, bam, it goes off and starts draining their accounts year after year.
So what in the world is an RMD? Well, it stands for Required Minimum Distribution. Basically, it's the government's way of saying, hey, you've had that money growing tax-deferred for decades, now it's our turn. Starting at age 73, you have to start taking money out of your traditional IRAs and 401ks. And every single dollar you take out is taxed as regular income.
And here's the fuse on that bomb. The problem gets worse every single year. You see, the percentage you're forced to withdraw actually goes up as you get older. It starts around 3.8% when you're 73, but by the time you're 90, it's over 8%. That means bigger and bigger withdrawals, which leads to, you guessed it, a bigger and bigger tax bill each year.
Let's make this real. Meet Robert. We can see his 2 possible futures right here. On the left, Robert does nothing. He just lets that RMD bomb go off. His first required withdrawal is so big it shoves him into a higher tax bracket. The result? Over 95 grand in extra taxes over his lifetime. Ouch. But look at the right. With one smart fix, he stays in the lower 12% bracket and saves over $82,000. It's the same person, same money, just a different strategy.
So how did he do it? What's the secret? It's all about strategic early withdrawals. You see that window of time between when you retire and when you turn 73? That's your golden opportunity. You start taking out a little bit from your IRA each year, just enough to fill up that low 12% tax bracket. Yeah, you pay a little tax now, but you're paying it at a bargain rate to shrink your IRA balance, which diffuses that RMD bomb before it can ever go off.
Okay, moving on. The next set of mistakes are all about timing. We're talking about taking the wrong income from the wrong accounts at the wrong time. Getting the sequence right here is absolutely critical.
So let me ask you a question. When should you claim Social Security? Now, most people think the answer is about maximizing their monthly check, but that's only half the story. The real question is about taxes, because when you claim can have a massive impact on how much of that benefit you actually get to keep.
Let's look at Linda's choice. Claiming at 62 is super tempting, right? Get the money early. But here's the catch. Because her benefit is smaller, she has to pull more money from her IRA to live on. All those IRA withdrawals make more of her Social Security taxable. Now look what happens if she waits until 67. Her monthly check is 44% bigger. That means she needs less from her IRA, her taxes are a bit lower, and look at this. She ends up with over $200,000 more in total benefits over her lifetime. It's a no-brainer.
All right, the next timing trap is pulling money from your accounts in the wrong order. The best way to think about this is what we call the withdrawal waterfall. Imagine your money is in 3 different pools. The first one you tap is at the top, your regular taxable brokerage accounts. Why? Because you'll pay low capital gains rates, maybe even 0%. Once that's used, the water flows to the next pool, your tax-deferred accounts like IRAs and 401ks. You take from here carefully to manage your tax bracket. And the very last pool at the bottom of the waterfall, that's your tax-free Roth money. You let that grow completely tax-free for as long as humanly possible.
And does this simple change in order really matter? Oh yeah, we're talking about an average savings of almost $38,000 over a 25-year retirement. And listen, this isn't some complex, fancy strategy. There are no loopholes. It's just about pulling from the right bucket at the right time. That's it.
Okay, for our last section, we're shifting gears a bit. The first few mistakes were about avoiding traps. These next 2 are about seizing opportunities. We're going to talk about missing out on chances to create tax-free money. Proactive moves that can shield a huge part of your retirement savings from the IRS forever.
Remember that tax opportunity window we talked about? You know, those magical years between when you stop working and when RMDs kick in at 73, when your income is probably the lowest it'll ever be in retirement? Well, that is the absolute perfect time for a Roth conversion. You're basically taking money from your taxable later IRA and moving it to a tax-free forever Roth. And you're doing it when your tax rate is on sale.
Here's exactly how that fill-the-bracket strategy works. Let's say your normal income from pensions or Social Security is about $40,000. You look at the tax brackets and see you have a ton of room left in that low 12% bracket. So you strategically convert $50,000 from your IRA to a Roth. Your total income for the year is now $90,000, but you're still safely inside that 12% bracket. You just moved a huge chunk of money into a tax-free account for life, and you did it at a bargain basement tax rate.
And the payoff? Is it worth it? Oh, absolutely. Just ask Patricia. By using this strategy, she saved over $103,000 in taxes over her lifetime. And, as a bonus, her kids are going to inherit a huge Roth IRA that they will never have to pay a single dime of income tax on. That's a legacy.
All right, our final tax-free opportunity. This one's for all you generous folks out there who donate to charity. If you're over age 70.5, there is a tool called a Qualified Charitable Distribution, or QCD. And honestly, it might be one of the most powerful and most overlooked tax strategies for retirees.
So how does this little bit of magic work? It's really simple. Normally, you'd have to take your RMD out of your IRA, count it as income, pay taxes on it, and then write a check to your favorite charity. With a QCD, you just skip all that. You tell your IRA custodian to send the money directly to the charity. The donation still counts toward your RMD for the year, but, and this is the key part, $0 ever hit your tax return. It's like it never happened.
And the savings here are real, and they happen every single year. Take Thomas and Susan. They donate $12,000 to their church every year. By using a QCD instead of writing a check, they save $1,620 in taxes every single year. Do that for 15 years, and that's over $24,000 back in their pockets. And the best part? The charity still gets the exact same amount of money.
Whew. Okay, so we've gone through the problems, the big mistakes, and we've also looked at the smart fixes. Now comes the most important part, turning all of this knowledge into your personal action plan.
So here it is, your action plan for this week. I want you to actually do these things. First, go online and calculate what your RMD will be at age 73. It might shock you. Second, take a hard look at your Social Security claiming strategy. Is it really the best one for you? Third, map out that withdrawal waterfall for the next few years. Know which account you're hitting first. Next, figure out exactly how much room you have in that 12% tax bracket. And finally, if you're over 70.5 and you give to charity, pick up the phone and call your IRA custodian about setting up a QCD. Seriously, these simple steps could save you tens of thousands of dollars.
So let me leave you with this question. Which one of these strategies is the one that could save your retirement tens of thousands of dollars? Because there's likely one in here that applies directly to you. The key is you have to take action. And for things like Roth conversions and QCDs, there's a hard deadline of December 31st. Don't wait. The time to make a plan and save that money is right now.